How does the CRA define Canadian source rental income for non-residents? If you're a non-resident of Canada earning money from renting out property in the country, the Canada Revenue Agency, CRA, considers that income to be Canadian source rental income. It's one of the most important and misunderstood principles in Canada's tax system. So what exactly does Canadian source mean, and how does it affect you if you live abroad? It's not about where you live, it's about where the property is. Canada taxes based on source of income, not on citizenship or residency alone. If the money you earn comes from a source within Canada, such as rent from a condo in Toronto, a cottage in Muskoka, or even a commercial space in Calgary, that income is considered Canadian source. It doesn't matter if you live in the US, India, Germany, or anywhere else. If the property is on Canadian soil, the CRA has full taxing rights over the income it generates. Rental income is always tied to property location, even if the money is paid to a foreign bank account, even if the landlord never steps foot in Canada, even if the property is rented short-term through Airbnb. The CRA still views that rental income as taxable under Canadian law. The CRA's legal authority. Under Section 216 of the Income Tax Act, non-residents earning rental income from Canadian property are subject to tax in Canada. By default, the CRA requires 25% withholding tax on gross rent collected by the property manager or tenant. This money is remitted directly to the CRA unless the landlord makes a Section 216 election. Section 216 allows the non-resident to file a tax return and be taxed on net income. Gross income minus eligible expenses like property tax, maintenance, insurance, and mortgage interest. This can significantly lower the actual amount of tax owed. Real example? Let's say you live in Dubai and rent out a Vancouver condo for $2,500 a month. That's $30,000 a year in rental income. Without a Section 216 election, you pay 25% of $30,375 to CR. With Section 216 election, you deduct $18,000 in expenses and pay tax only on the $12,000 net income, which may result in $1,500, $2,000 tax depending on the rate. That's a potential savings of over $5,000 simply by understanding what Canadian source income is and filing correctly. Final thoughts. The CRA's definition of Canadian source rental income is straightforward. If your property is located in Canada and generating rent, it's taxable, regardless of where you live. Understanding this core principle is step one in staying compliant, avoiding penalties, and maximizing the return on your Canadian investment. Need guidance on non-resident rental tax compliance? Call 416-283-8774 or visit theaccountingandtax.com.